Transfer pricing is a lot of fun. And if you remember transfer pricing from cost accounting, um, what we're going to talk about now is something completely unrelated to transfer pricing, and that is, well, completely related to it, is how to undo it. So previously, when you were talking about cost accounting, you were talking about what the ideal transfer price was. And if you remember from cost accounting, it was supposed to be the fair market value if you get it, because that would be the value at which the selling division would be able to sell to the outside. And this way, the selling division, provided that the purchasing division makes a competitive offer, the selling division could sell it at either to the outside or to the internally. And there were other approaches to do it also, and there were pros and cons to doing the others. But what we liked the most, if you remember, was market value. Anyway, transfer pricing creates a problem for us in financial accounting. It's great for managerial accounting because what it does is it allows the different divisions that make and sell the goods and work on them to to share in the profit on them. But from a financial accounting point of view, it's completely illegitimate. It's actually fraudulent because from a financial accounting point of view, GAAP, the sale has not taken place until the entire company has sold it to an outside unrelated party. So if you have a factory, again, selling to a store that are owned by the same parent, that's not considered to be a sale. Even though under transfer pricing, we would try to set the right price and allow the factory to record a sale so the factory could record profits and function as an investment center or as a profit center. So failure to eliminate intercompany transactions would result in double counting sales and cost of goods sold. And it just would not be GAAP. So from a consolidated perspective, the sale really has not taken place until the entire company has sold the goods to an outside party. And moving inventory from one subsidiary to another is not considered a real transaction from a consolidated perspective according to GAAP. Another problem is recording profit. Under GAAP, profit should be the difference between the sales price and the cost of goods sold, i.e. the cost of purchasing or making the goods, the cost of buying goods from the outside. And that cost of sales should not include any internally generated profits. It should only include the real cost to the consolidated entity. Income taxes pose a huge challenge here because when the selling entity records that gain, it may also be liable for income taxes. And those income taxes also need to be eliminated and deferred because they need to be matched against the actual income, which is not going to be recorded until some part of the consolidated entity sells the goods to the outside. So I'm saying that as a side issue because we're not going to deal with it here. We're not going to have any income tax at all. But if there were tax effects, then the tax effects of these gains would also need to be eliminated, even though they might need to be paid by the entities. Now, an added complication comes up. With downstream sales, the entire profit is eliminated because the entire profit could be construed to belong to the parent. But when you have an upstream sale, the gain, I'm sorry, I should have said what upstream, downstream is. Downstream is when the parent sells to the subsidiary. Upstream is when the subsidiary sells to the parent. And let's suppose that there's a non-controlling interest. Well, if the parent sells to the subsidiary and there's a non-controlling interest, all of that gain supposedly belongs to the parent. And of course, the 100% of it is deferred. But what if the subsidiary sells to the parent and there's a non-controlling interest? A portion of that gain belongs to non-controlling interest. And do you also have to defer that gain? And the answer is yes, because the parent controls the entire sub, so the parent can control when these gains occur. And therefore, the gain to the parent would, the entire gain in an upstream sale would be deferred until the parent sells to the outside. So a transaction between affiliates really has no substance and has no place at all in consolidated financial statements. And let me repeat that. Transactions between affiliates have no substance and no place in consolidated financial statements whatsoever, and they must be eliminated. So it doesn't matter if the seller delivered the product. It doesn't matter if the seller collected money on the sale. The cash flows, whatever, none of this matters at all. The only thing that matters is whether the sub sold the inventory to an outside unaffiliated customer. And any movement of the inventory among the different entities controlled by the parent, including the parent itself, are considered to have no substance and therefore should not be reflected in consolidated financial statements. So what you need to do is, when you're doing your consolidation, is you need to assure that the effects of all of these intercompany transactions have been completely eliminated so that they're not reflected in the consolidated financial statements. The only item that should appear on your balance sheet is the cost of the inventory. And the only sales and cost of goods sold that should appear on your income statement are sales to outside parties and the cost of goods sold that was incurred in purchasing goods from the outside. And cost of goods sold should not include any profits earned in intercompany transactions. So let's take an example here. I'll just skip that one and go straight to here. Let's say parent bought goods for $3,200 and sold the goods to the sub for $4,000. The $4,000 of the $4,000, the sub resold $3,000 of that, and $1,000 is still sitting on inventory. So the portion that was sold to the outside, the $3,000 was sold to the outside party. That is a legitimate sale. But the $1,000 that's still sitting on the books of the sub includes this illegitimate profit. So what we could do is we could split this out in this way. And this is a nice chart that the book has. The total sale was for $4,000 minus $3,200 cost of goods sold is $800 gross profit. So the gross profit percentage here is 20%. Of this, $3,000 was sold to the outside and it's good. So you have a $3,000 sale with real cost of goods sold of $2,400. And therefore gross profit is $600. And that would be if cost of goods sold here is 80% of sales, then this real cost of goods sold is also 80% of sales. The remaining $1,000 worth of goods sitting on the books of sub were not yet sold to the outside. They have a cost of goods sold of $800, and that's what should be on the sub's books, but $1,000 is there. And there's unrealized gross profit of $200, which would need to be deferred. So when you're doing a problem like this, you may have the sale and the cost of goods sold from the parent to the sub or the sub to the parent, and you may know how much inventory is left, and you got to fill in the rest of the blanks. So what we would assume is that this gross profit is consistent when we go through this. And in this case, for example, the gross profit is $1,000 or 10%. So of this $7,000, the cost of goods sold, the amount sold to the outside, 90% was cost of goods sold and 10% was gross profit, and that's realized. That's good that you can record that on your consolidated income statement. But the $3,000 that's still sitting on the books of the sub, $2,700 is cost of goods sold and $300 is unrealized and needs to be deferred until it's sold to the outside. So this is one way of looking at these problems, and we'll see a number of these when we get into them in more detail. And the way they're going to do it here is that gross profit is presented as a percentage of sales. So 10%, you have sales, gross profit is 10% of sales. Sometimes profit is portrayed, you have what's called a markup on cost, and then it's the percentage of cost of goods sold rather than sales. And we're not going to, I'm going to do everything I can to avoid that because that just creates confusion. Now, what happens to the portion that's still sitting on the books? There's $300 in unrealized profit, which was recorded by the parent when they sold it to the sub. And now the sub has $3,000 in inventory that really only costs $2,700 because the parent recorded the extra $300 in gain. So under the fully adjusted method, again, this will be eliminated in consolidation. And under the fully adjusted equity method, the unrealized profit or loss needs to be deferred until the subsidiary, or whoever bought the goods, till the subsidiary sells the goods to the outside. Then you can record that $300 gain or gross profit. And what we want to do is we want to make sure that net income is not overstated and that retained earnings is accurate on the books of the parent. So if the parent defers this, right now the parent has a $300 gain on their book, which is not GAAP. And if we try to consolidate that, that will give the parent income on their books overstated at $300, and it would be eliminated in the consolidation anyway. But we want the parent to accurately have an accurate set of books under the fully adjusted equity method. So what we would do is we would take the gain back off the books. Now, what if you, again, had an upstream transaction? If you had an upstream transaction, then the sub is recording the gain and the parent owns the sub. So would the parent eliminate 100% of the transaction or the proportionate share? And in that case, the parent, if it's an upstream sale, the parent is only going to defer the portion of the sub that the parent actually owns. The reason why is because the parent only gets that percentage of the income anyway. So they can only defer the portion of the income that they own. But on the side of the sub, we're not gonna allow the sub to record that income. So the journal entry on the parent's books to defer unrealized gross profit using the fully adjusted equity method would be to debit income from sub and credit for investment in subsidiary. Because what's happened is that the parents recorded additional gross profit, and this will offset that additional gross profit. It's interesting that they don't debit gross profit, or rather debit sales, credit cost of goods sold, and then the difference goes to the investment account. But instead what we do is we put it into income from subsidiary in order to kind of mark and record that this is a transaction with a sub, and it's going to reverse when the sub sells the goods to the outside. So this way, the transaction is organized on your books with the subsidiary's account, and you're going to know where to find it. So in a downstream transaction, when the parent sells to the sub, 100% of the gross profit is going to be eliminated. In an upstream transaction, only the parent's proportionate share of the gross profit is going to be eliminated because that's all the parent owns. If the parent owns 80% of the sub, the parent records 80% of the profit. Therefore, they're only going to get 80% of that gain eventually anyway. So the parent might as well only record its share of that gross profit. And this is going to be only until the goods are sold to the outside. When the goods are finally sold to the outside, the parent is going to debit investment in subsidiary and credit income from subsidiary and reverse this previous entry in order to record the income. This can get very complicated. So remember that the income statement of the consolidated entity is only going to record sales to outside entities, and the cost of goods sold paid to outside entities to purchase or make the goods that were sold. And the balance sheet, on the balance sheet, inventory will be recorded at cost and not include any gross profit on intercompany transactions, which would not be GAAP.